Hello, I'm Jacob Gunter. I'm a lead analyst on the economic research team at Merics, the Mercator Institute of China Studies, a China-focused research institute based out of Berlin. And today I'm going to be talking a bit about China's evolving trade and investment strategies, sort of as a 101 primer for those who are trying to tackle China from a position where maybe you don't quite have so much depth on it yet, but you're trying to build some core knowledge. This is part of the ReConnect China project. And what I want to focus on is not only China's own strategies around its trade and investment sort of agenda, and think about its implications for China, but also to encourage viewers of this lecture to think about the implications that China's own strategy and the success or failure of that strategy might have for your own countries and your own companies. So we'll start off at kind of a 30,000-foot perspective, very big picture, to sort of walk through the history of the modern People's Republic of China and its sort of economic policy as it relates to trade and investment strategies. So starting with sort of the Mao Zedong era, we have these kind of three periods where, starting with Mao, of this idea of China standing up to the world and standing up on its own. And what that means for trade and investment is incredibly negative. There's a pretty profound breakdown in trade and investment between China and most of the rest of the world. In large part, this is because China doesn't want foreign investment. It doesn't want to become dependent on foreign trade because it sort of wants to maintain a large degree of self-reliance and self-sufficiency within its own market, so as not to be dependent on anyone and not to be at risk of foreign powers abusing and manipulating that relationship or abusing and manipulating the Chinese people. So trade is incredibly limited during the Mao era. For a while, it's pretty strong with the Soviet Union until the Sino-Soviet split. And then China's basically left with a handful of very, very minor trading relationships. And a lot of that trade is focused on exports of raw materials, food, things like this, and imports of the kind of machinery, for example, that China cannot produce on its own. But this focus on self-reliance means a pretty profound breakdown with China's economic relationship with the rest of the world. And that completely starts to change in the next generation under Deng Xiaoping. Deng is sort of the great reformer, and where Mao Zedong had this mantra that China has stood up, Deng Xiaoping has this mantra that China must become rich. And he sets out on a path of pretty ruthless pragmatism to make that happen. There's this whole concept called it doesn't matter if a cat is white or black, what matters is that it catches mice. So officials are encouraged to think about any possible means of promoting China's development to help people actually have more and more prosperity. And a really critical part of this is the opening up of trade routes and trade relationships with many other countries around the world, and also things like the development of these special economic zones that sort of become the laboratories of Chinese economic policymaking and of China's building ties with the rest of the world. So trade starts to go up significantly. Foreign investment comes in, especially into the special economic zones. And they're not producing technologically sophisticated things. They're producing really cheap consumer goods, mainly for export to foreign markets. But this becomes a critical part of Deng Xiaoping's strategy, is sort of plugging China as a country that is sort of resource poor but is manpower rich, to plug China as a sort of manufacturing base into global value chains, and to let this be one of the main drivers of growth. This advances further under Jiang Zemin. We see pretty extensive liberalization of the market within the country, but we also see China's eventual accession to the WTO, which is revolutionary in terms of the importance to China's economy, because it suddenly creates the conditions for the economic miracle to really get going. Because China effectively then gains market access, and its manufacturing base gains market access to most of the world's economies. And a lot of the reforms that are necessary for WTO accession also promote development within China. But throughout this period, throughout the Jiang Zemin period, China is exporting a lot. It's importing a lot of raw materials and such. It's importing a lot of capital and technology and machinery and things like this. And it's exporting a lot of cheaper consumer goods, but it's slowly climbing up the value chain. And there's a really strong emphasis on starting to attract more and more foreign investment in FDI, to bring technology to China, to produce in China, not only to export, but also to sell to Chinese consumers. Um, Now, there's a little bit of a bump in the road with Hu Jintao. There's a little bit of a stabilization of the liberalization efforts internally, but in terms of China's trade and investment ties with the rest of the world, things generally continue to open up more and more and more. And so this whole period between Deng Xiaoping and the end of the Hu Jintao era is sort of the core of the economic miracle, where China's door is continuously opening up, and trade and investment ties get ratcheted up further and further year after year. All of this starts to change a bit, in mostly or in both positive and negative ways under Xi Jinping, starting in 2012 when he takes power. Um, and he sort of begins with this, and there's an expectation that he's going to continue with this policy of reform and opening up, and continue with this policy of intense trade and investment ties with the rest of the world. And a lot of that generally actually remains true, but the conditions that it happens with change. And importantly, the strategy behind it changes pretty profoundly. So there's this concept that Xi Jinping announces a few years ago, but it's clearly been at the core of his thinking, or something similar to it has been at the core of his thinking for quite some time, which is this idea called dual circulation strategy. So this is first announced in 2020, but if you go back to the Xi Jinping administration, it's clearly had this kind of thinking has had an impact, more generally. So the dual circulation strategy, which is sort of the right part of this chart here, is sort of a new way of thinking about China's relationship with the rest of the world and China's own development path. So on the left, with the Great International Circulation Strategy, this is sort of the Deng Xiaoping idea that China doesn't have much in terms of resources or technology or capital, but it has a huge manufacturing base in terms of manpower, and we will plug ourselves into the global economy. And so raw materials, technology, and FDI and such will come into the country. We will make things, and we will send finished goods to the rest of the world. And that in terms of the relative importance of China's domestic economy versus China's relationship with the world economy is going to be the primary driver of development and growth. This works incredibly well for quite some time. Xi Jinping wants to change that by creating a Chinese domestic economy that is more self-driven. So that means much higher consumption. That means being less reliant on foreign capital and FDI and foreign technology, and more reliant on China's own growing capitals and investment base and its technology and innovation capacities, to the point where China will no longer be importing a lot of those things. It'll become self-reliant in those. And instead, it's going to focus on importing raw materials and kind of low-value goods, with the hope being that eventually China will continue to be a really important exporter, but that it will continue to climb the value chain, and will be exporting more high-value goods and be exporting more technology, and we'll see more outbound FDI. That China will become an investor in the rest of the world rather than sort of a net recipient of foreign investment. A lot of this is driven by Xi Jinping's sort of obsession with security and geopolitical concerns. A big part of the problem in Xi Jinping's mind with the previous strategy is that it makes China profoundly dependent on the rest of the world for its economic base to continue to exist. And so shifting towards this more self-reliant model where China's own market is the source of growth, its own innovators are the source of technology, and its own manufacturing base is the source of high value added goods, is a pretty profound change. And again, geopolitics is kind of at the center of that strategy of becoming less reliant on China's ties with the rest of the world. Yet, what we see is that China actually remains profoundly dependent on exports. And a lot of this is really driven by issues within China's own domestic economy. that has limited the ability of the consumer base to expand and the middle class to continue to expand, to be able to absorb more of what China's producing. It also has to do with a lot of political factors in China, and it has to do with kind of a policy agenda that is very much focused on the productive side of the economy. So let's kind of go through and break those down. That what we've seen, especially in the last 4 or 5 years, has been a pretty gloomy time, economically speaking, for China. Now, a big part of that, of course, is the pandemic. But what we also have is other countries around the world finally start to really meaningfully push back on China's economic model and the impacts that it's having on other countries. And this really begins with the United States, of course, during the Trump administration. But it continues under the Biden administration. This is a very bipartisan approach in Washington towards China, which is we start with the trade war, Donald Trump and his tariffs, that eventually reached the point where effectively every good going between the US and China or China and the US is hit with a 25% additional tariff. And those have gone up for specific products. But more importantly, beyond the trade war and the tariffs, is sort of a technology war that the United States and China have been at one another, or at with one another. At the center of that is, of course, the semiconductor story. This is sort of the classic example that America doesn't want China to catch up in sort of the cutting edge of semiconductor technology, both in terms of the chips themselves, but also the manufacturing equipment and the software necessary to produce them. This is primarily because of national security reasons, but there are also economic security reasons that have begun to come out. We also see China starting to hit headwinds, even in very open markets like in Europe, where the European Union just this summer in 2024 announced the sort of conclusions of these investigations into China's electric vehicle exports and the subsidies behind them and the impact that they have on the European market. Japan has had Japan and Korea and Taiwan, they've had their own diversification and de-risking agendas for quite some time. So internationally and externally, China's running into a lot of headwinds. And then internally, we've seen really, really weak growth in consumption. The middle class is no longer growing the way it used to be. Investor and consumer confidence is incredibly weak. And a lot of these wounds are also self-inflicted, where we see this really intense crackdown on real estate, which is one of the key drivers of China's economic growth. So a lot of these things are really hurting the internal circulation aspect. So China's not able to boost its consumption. But at the same time, a lot of the policy factors in the Chinese government are not trying to support an expansion of consumption. They're taking the limited resources that they have and they're promoting production and the supply side of the economy. So there's more and more investment in manufacturing. And the problem is if you're investing in more and more manufacturing capacity, you're going to have a problem if you can't absorb that consumption. If you can't absorb that internally through consumption. And this helps explain the massive increase in China's exports that we see between 2008 up to last year. Importantly, though, to kind of zoom in on a few specific examples to help kind of illustrate how China thinks about its economic or its trade ties with the rest of the world. Everyone talks about and focuses on semiconductors being this really critical area that China is very dependent on, and that is trying to close the technology gap so it's no longer dependent on American, Japanese, and European technology. At the same time, though, there are also things, much more basic things, that China is profoundly dependent on imports for. Things like iron ore. China imports about 72.4% of total global imports of iron ore. It doesn't produce anything near what it needs for its massive steel industry. And it's almost entirely dependent on imports from Australia and Brazil to be able to feed its massive steel sector. This is something that China can do nothing about. It can try to invest a bit more in Brazil, but it is profoundly dependent on Australia because no magical thinking and no investment is going to magically create iron ore deposits underneath the land in China. Same thing with something like soybeans. China has a very small amount of fertile land, considering the size of the country. So it has to import some of its food, and soybeans are one of the things that it's not so focused on self-reliance on. Um, and oil and natural gas, a lot of these kind of basic fundamental commodities, Beijing has no choice but to import, and it tries to diversify its import relationships, so not to be too dependent on anyone in the areas where it can be. But we also see some real success in China's export-led kind of focus in terms of more and more value-added exports driving growth. So China is no longer exporting cheap electronic goods and toys and strollers and things like that. It still exports a lot of those things, but it's also exporting a lot more advanced technology and higher value-added goods. So you can see on this chart, it's no longer just things like iron and steel. It's also things like lithium-ion batteries and electric vehicles. Importantly, though, a lot of that pushback that I mentioned, the kind of external factors that are slowing down China's strategy, are coming from, again, problems in the domestic economy. So this chart here is quite important. What we see is the blue line is the share of loss-making industrial enterprises in China. So if we go back to pre-WTO session and sort of early days of liberalization, we see almost a quarter of Chinese industrial enterprises are loss-making. And that number continuously goes down. And then Xi Jinping takes over, and it slowly starts to go back up. And then the pandemic accelerates that a bit. And a lot of that has to do with the domestic agenda and this kind of constant emphasis on produce, 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 invest in more factories, invest in more production. And a lot of the subsidies within the Chinese model facilitate these loss-making companies to continue to exist rather than exiting the market. The problem is that this is a really core issue driving this huge wave of exports. And this is often cited as a problem of overcapacity, that basically China is overinvesting in its production side of things, and it's doing too much to try to support that, and it's not doing enough to support consumption, and therefore more and more Chinese goods need to seek markets abroad because they cannot find consumers at home to buy everything that they're producing. And this is starting to create a lot of that pushback. So I already mentioned the US and Japan and such in Europe, but even other countries like Brazil are starting to now really launch investigations into the degree of Chinese state support and the issue of these loss-making enterprises and such. And in the past, when China was running these loss-making enterprises, this was a problem for China. It was a bad allocation of capital. It was inefficient. The problem is, back when China was only about 5% of global manufacturing. Now that China's around 30%, this is a problem for the rest of the world. Now, very quickly, I'm going to do a little summary of how China treats inbound and outbound investment. I won't go through in too much detail on each of these because you'll be able to pause the video and have a look. But importantly, part of China's opening up agenda, and this includes under Xi Jinping, on paper, actually, China has meaningfully opened up quite a lot for inbound FDI. Because Beijing would much rather have more advanced technology being produced in China under its own jurisdiction, even if it's by foreign companies, than have to remain dependent on imports from abroad. So there's actually been a pretty significant increase in rolling out the red carpet to try to attract foreign investors into the market to basically localize and bring that technology. One issue that China's increasingly running into is more and more skepticism from foreign companies and foreign governments because of these this sort of three-phase approach and pattern that I've illustrated here. So the original story of this really comes with traditional rail, but especially high-speed rail, where there's a technology attraction phase. They intentionally try to invite in foreign investment. To bring their technology in. They push them into joint ventures with local Chinese companies, usually state-owned. They oftentimes compel technology transfer as part of that, with the promise for the foreign companies being that you're going to have this huge market and you're going to make so much money that it doesn't matter that you have to split it with a joint venture partner and that you have to transfer your technology. So the Japanese and European rail companies jump in, thinking that they're going to be major players in China's high-speed rail rollout. Over time, China kind of catches up in those technologies and masters the business side of things. And we see this kind of home market consolidation phase in which basically the foreign companies over time get sort of squeezed out as unwelcomed competition for market share in China. And then the Chinese companies have basically, especially in the case of high-speed rail, but also telecoms, have basically exclusive access, and they don't have to worry too much about competition. And so they have massive amounts of revenue coming in to feed their R&D and to expand their economies of scale. And that's when they eventually move into the third market expansion phase, where these companies that once relied on inbound foreign investments and joint venture partnerships and technology transfers, these companies are now going out and they're competing with their old partners, their old foreign partners in third markets. This has happened with traditional rail and high-speed rail. This is kind of in a late stage with telecoms. This is kind of at a mid to late stage with EVs. It's kind of at an early to mid stage in a lot of other sectors, like in industrial machinery and medical devices and others. So understanding how China's attraction of foreign investment and then its eventual assertion of outbound FDI fits into these bigger strategies is really important. It has significant implications. So an important distinction when we're looking at that outbound FDI is a lot of the times the outbound FDI from China's SOEs, the state-owned enterprises, are really meant to fulfill kind of strategic roles. So in the case of this example that I have here, this chart that this map that I put together with my team shows this company COFCO, which is one of the big food trading companies in China. They have this massive global footprint to explicitly to facilitate the export of food and agricultural products from these markets back to China. Unlike other food trading companies, which they're happy to buy and sell food between all sorts of different markets, a company like COFCO is very specifically tasked with going out, investing in food production and transportation facilities to get food back to China. You see some very similar things with a lot of the energy companies, but you also see some other strategic roles that China's state-owned enterprises play. China's Belt and Road Initiative, this really big infrastructure development initiative that's been around for about 12 years now. This is also a state-owned enterprise game. It's Chinese state-owned enterprises going and helping to build and operate ports and pipelines and railways and airports and these kinds of infrastructure. And that's strategically very important for Beijing and also for its relationship with a lot of those countries. So these are not necessarily fulfilling things on a commercial basis because of market forces. They're doing it because they fulfill a strategic role. And in contrast, most of China's private companies tend to behave a little bit, they're increasingly behaving more like big multinationals, at least overseas. Domestically, they have to deal with a lot of political nonsense that makes them not so much behave like big MNCs. But overseas, they're starting to behave more and more like major international kind of companies. And a good example of this in a cutting edge technology where China has leadership is BYD, which is one of the big EV makers. They make passenger vehicles, but also commercial vehicles like buses, all electric. So you can see that they've actually, and this is almost a year old now. A lot of this outbound investment and trade and such is meant to be producing and selling in those markets to those markets, into regional markets. So there is that important distinction in terms of China's outbound investment strategy, the way that Chinese state-owned players versus private players behave. And I'll kind of wrap it up there. Sort of in conclusion, that a really important caveat to everything that I've just presented today is that these are a lot of what China's strategies are. That doesn't necessarily mean that they're always successful in every single way. We often sort of imagine China has this magical ability to have a policy about something, and because they have a policy, they're going to have the outcome that they desire. Now, they often do, and sometimes they don't. And so we should continuously be studying and researching China and the progress that it is and isn't making in these strategies. But with all of that, I've left a few questions for further consideration, especially thinking about things from a Chinese perspective. So, is their current strategy sustainable? What kind of internal factors might affect it? But also think about external matters, like what kind of external things, like a trade war, technology wars, and tariffs and investigations might impact China's trade strategy. What about the implications for other countries that if China is actually incredibly successful with all of its agenda, what kind of implications might that mean for your own country and for the companies there and for the manufacturers and workers and such in your country? And also thinking a bit about, China's absolutely obsessed with dealing with its dependencies, its import dependencies in particular. So and we increasingly see a weaponization of China's exports in areas where other countries depend on China, and like for a lot of critical mineral refining, for example. There are a lot of minerals that maybe they're mined all around the world, but they're only refined in China. So China has kind of a choke point there. So think about like what in what areas is your country dependent on imports from China, but also are there areas where China is dependent on exports from your country? So I hope this has been interesting and useful for everybody, and I hope these questions occupy some space in your minds to try to think through some of these because a lot of these have implications that we're going to be dealing with for years and for decades to come. Thank you.